On May 18, 2025, the world watched as credit rating agency Moody's made a significant move. It downgraded the United States sovereign credit rating. The rating went from AAA to AA1. This sent shockwaves through global markets. The downgrade reflects growing concerns about the U.S. economy. Moody's cited rising deficits and a ballooning national debt as key factors. This move follows similar downgrades by Standard & Poor's in 2011 and Fitch in 2023. Investors are now grappling with the implications of this decision. This event is a stark reminder of the interconnectedness of the global economy. When a major player like the U.S. experiences turmoil, it sends ripples across the world. Emerging markets, including India, are particularly susceptible to these tremors. The Indian stock market, a barometer of the nation's economic health, reacted swiftly to the news. The news from Moody's sent immediate shockwaves through the Indian stock market. Benchmark indices, the Sensex and Nifty, tumbled upon the announcement. The Sensex, representing the Bombay Stock Exchange, plummeted by 459.53 points. It closed the day at 81,964.57, a significant drop reflecting the widespread anxiety. The Nifty, reflecting the performance of 50 top companies on the National Stock Exchange, also took a hit. It dipped below the psychologically significant 25,000 mark, closing at insert closing value if available. Several factors contributed to this downturn. The IT sector, heavily reliant on U.S. revenues, experienced a sell-off. Major players like Infosys, TCS, and Wipro witnessed their share prices slump. Adding to the pressure, the India VIX, a measure of market volatility, shot up by 11%. This surge to 19.81 indicates heightened investor fear and uncertainty. The market's reaction underscores the strong link between the U.S. and Indian economies. Moody's decision to downgrade the U.S. credit rating was not taken lightly. It reflects a culmination of concerns that have been brewing for some time. At the heart of the issue lies the U.S.'s staggering national debt. Now exceeding $36 trillion, the debt has reached a level that many economists consider unsustainable. This is coupled with persistent budget deficits, indicating that the government is spending more than it earns. These factors have raised alarms about the long-term health of the U.S. economy. Moody's explicitly cited these concerns as the basis for its downgrade. A lower credit rating makes it more expensive for the U.S. government to borrow money. This, in turn, can have a cascading effect on interest rates and economic growth. Section 4. A ripple effect, U.S. Treasury yields and global markets. The downgrade of the U.S. credit rating sent immediate ripples through the global bond market. U.S. Treasury yields, a key benchmark for global interest rates, spiked. The yield on the 10-year Treasury note, a closely watched indicator, surged to 4.52%. The 30-year yield, reflecting longer-term borrowing costs, crossed the 5% threshold. This surge in yields is a direct consequence of the downgrade. It reflects a heightened perception of risk associated with U.S. debt. As U.S. Treasury yields rise, they exert upward pressure on borrowing costs worldwide. This has implications for businesses and consumers alike, making it more expensive to access credit. The impact was felt across global stock markets. Asian and European markets mirrored the negative sentiment, with major indices experiencing declines. Section 5. Troubled waters. Indian IT sector faces headwinds. The Indian IT sector found itself caught in the crosshairs of the U.S. credit downgrade. Heavily reliant on U.S. clients for revenue, Indian IT companies faced immediate pressure. The uncertainty surrounding the U.S. economy raised concerns about potential cuts in IT spending. This led to a sell-off in Indian IT stocks, with the sector as a whole declining by over 1.5%. Major players like Infosys, TCS, and Wipro felt the heat, with their share prices experiencing notable declines. These companies earn a significant portion of their revenue from U.S.-based clients. Any slowdown in U.S. corporate spending on technology services directly impacts their bottom line. Section 6. Navigating the storm: insights and investment strategies. The events following Moody's downgrade of the U.S. credit rating serve as a stark reminder of the volatile nature of financial markets. While the immediate reaction was one of fear and uncertainty, it's crucial to maintain a long-term perspective. Market downturns, while unsettling, can also present opportunities for astute investors. Here are some key takeaways for investors. Diversification is key. Spreading investments across different asset classes, sectors, and geographies can help mitigate risk during volatile periods. Focus on quality. In times of uncertainty, it's prudent to focus on companies with strong fundamentals, sound balance sheets, and a proven track record. Stay informed. Keeping abreast of market developments and economic news is crucial for making informed investment decisions. The current market turbulence may persist in the short term. However, maintaining a balanced portfolio, conducting thorough research, and seeking professional financial advice can help investors weather the storm. Follow at Dalal Street Decode for tomorrow's episode.